So, congratulations on the book. It's Unintended Consequences, and it's gotten a lot of attention for your ideas. It's quite provocative and interesting. What motivated you to write this book?
I felt like I had something to say, and maybe I was frustrated with what I heard in the media about the economy on both sides of the debate, and felt that I wanted to try my hand at clarifying it. And I felt like I needed to make my contribution as best I could, because I had done that at Bain Capital and felt like I needed to try something different and new, and then I had to try to do something that was important.
So, you mentioned Bain Capital. I'm just curious, there are a lot of interesting ideas and thoughts in this book. Maybe you could tell me, where these ideas come from. Are these ideas that have developed over a long time from your career in finance and at Bain and other places? Who are your influences in how you think about the economy and what's in the book?
Well, it evolves from debates I had with young kids that came out of the top schools, who came to work for first Bain Consulting and then Bain Capital, who wanted to argue economics and politics. And I kept saying, when you get to be 40 or 45, here's why you're going to become conservative. And I think it evolved from that. But I also benefited greatly from a friendship I had with Bruce Greenwald, who's a professor at Columbia, who I was able to make my arguments to, and he'd frequently say, right on this, but you're stepping on a landmine here, stepping on a landmine there. And it's not to say that he agrees with everything in the book. He doesn't, but I think he helped me sharpen up my understanding of economics. But that's really the source. And I think part of it came from my experiences at Bain Consulting and at Bain Capital. I think Bill Bain taught us that almost all the value that's created by businesses is captured by the customer, not by the investors, and that the investors only capture a very small piece, which is their advantage relative to competitors, and that business is in a race to deliver more and more value to the customer, and that the competition keeps you honest, if you will, in delivering more and more value, and that you're only capturing a very small piece of that. And I think that plays into the economics that underlie the thinking in the first half of the book.
Yeah, so tell me if this is a fair characterization, but it felt like there were two real distinct pieces to this book. One, looking at the financial crisis, and one, this larger view that I think you were just referring to about how the broader economy works. Let's start with the second one. I wonder if you could just, what makes an economy grow? What are the most important things? What are the keys?
Well, I suppose that goes to Robert Solow. So investment per employee, I think, would be one. Education would be the second, and I think in particular on-the-job training has been my own experience, and innovation being the third. And the more of that you have, the faster the economy will grow, the higher the incomes will be. I think another way to think about it is, how much equity do you have or that you at least think you have, and your willingness to take risk, to put that equity at risk, to underwrite the risk that grows the economy and creates jobs. And that when you are in, say, 2007 and believe you have a lot of equity, you're willing to consume a high share of your income, you're willing to invest, and you're willing to make risky investments in innovation, say, rather than working capital that's simply responding to growth in the economy. And that those things drive the economy, and that after the crisis, when real estate prices drop 30%, you believe you have a lot less equity, probably do have a lot less equity than you realize, and so you rein in risk-taking, and economic activity contracts to adjust for the amount of equity you have. You start saving instead of consuming to build back your equity reserves, and you start dialing down economic activity to compensate for the less equity that you have. You feel less comfortable taking risks. So I think that's on a macro level what makes the economy ebb and flow in the short run, and then on a long run, in the long run, I think it goes back to Robert Solow, with the investments that you're making in the long run and driving you up, driving the growth rate in the long run.
In the, you referenced sort of this current situation we're in. And you're focusing on kind of the availability of capital, of the level of equity you have. Where does demand fit into this picture? Currently, a lot of people focus on the debt overhang of the middle class and sort of and the lack of demand as the reason they're not investing, not in that hiring. If you read the business press, if you kind of talk to business people I talk to, that's what I hear more than lack of a capacity to invest.
Yeah, I believe that demand is a symptom; it's not a cause, and that the underlying cause of demand is the amount of equity that people have. So homeowners, particularly the middle class, who had almost all of their financial investment in their house, and now the house is down 30% in value, and it's levered up quite heavily, so they've suffered even a higher loss to their equity. I think they dial back their economic activity, in their case chiefly consumption, and that they try to accumulate deferred consumption as a way to increase their equity, and that causes demand to decline. And so I think when you think about the problem this way, I think you say, geez, any money that I take from one person to give to another to increase that other person's demand will be offset by a reduction from wherever the money came from. And so the Keynesian multiplier effect, I think you're much more skeptical of that and what the size of it would be, and you tend to be more in the, lack of a better word, rational expectations camp, that people will look at the total amount of risk that's being taken and they'll make some intuitive reduction. As the government tries to increase, they'll offset with a decrease.
One of the things you really emphasize is this, particularly in the longer term discussion, is the importance of taking risks and the importance of sort of innovator risk, investor risk. I wonder if you'd talk about that a little bit more. I thought that was very interesting, sort of the role of risk particularly and the willingness and ability to take risk to make the economy grow.
So I make the argument in the book that payoffs for risk-taking drive the amount of risk-taking that we get. And it's probably true that if we increase the tax rates, we won't get a rapid contraction in the amount of risk-taking, but that has a compounding effect that can grow quite large over time. In the same way that if we stopped investing this year, it's not like the economy would collapse. It would gradually slow down over time. And so higher payoffs for risk-taking, one is that they increase the bar for success. That in the United States, the most talented people worked longer hours, while their counterparts in Europe and Japan worked fewer hours. And in the rest of the economy, as people have grown richer, they've had a reduction in the amount of work that they've done. And so that's one of the things that happens, keeping up with the Joneses, if you will. That work effort and the risk-taking that it represents creates companies like Google and Facebook and countless of other companies and innovations that we've enjoyed in the United States more than in Europe and Japan. And that creates valuable on-the-job training for our most talented workers. And so again, you get that training, it increases your probability of success. You have a network of engineers and business people who are familiar with what's going to be successful in the internet, for example. You're all located in Silicon Valley. That has magnifies the payoffs and increases the probability for risk-taking. And the third is that success puts equity into the hands of people who are willing to underwrite the risk that produces innovation. And those three things compound and gradually build over time. And we end up with an economy that grows faster, has higher median wages, has faster growing employment than Europe and Japan have enjoyed over the last 2 decades.
It seemed like in the book you talk about different kinds of people that take risks. And one of the groups, I guess, is what I'll call the innovators, or the people who sort of start these businesses, the people who, I know you've talked about, the people who take the risk of leaving a secure employment, leaving Google to go start the new thing, the big thing. And you focus on increasing the payoff for that, basically.
Yes.
And it's kind of your argument for lowering taxes, and stop me if I'm mischaracterizing here, but for lowering the taxes on kind of that payoff. And I think one thing that I thought, in thinking about that I thought was interesting was that, so I've known people who've been in that position. Mm-hmm. I used to be involved in technology, and I know, a group of people, including my father, actually, who made a choice like this. And, and sometimes they've asked me for advice, and we've discussed it. And what I thought was interesting to me was there was some of it is they just have a cool idea and they want to go explore it and they want to do something different and it's exciting. But some of it is definitely they're looking at this possibility of life-changing wealth. That's definitely an attraction. But I must say, at least in my experience, like if it's life-changing wealth, if it's 10% more or 10% less, that isn't a big difference to them. But do you think in that situation, you think that sort of the difference in like the range of possible tax levels is a big factor?
I think we all know that before the fact, when Mark Zuckerberg took risk, I'm sure he never expected to be as wealthy as he was. So we know he was willing to take the risk for a much, much lower payoff.
Yeah.
I think is where you're what you're describing, and certainly it's hard to argue with that. But I think